Starbucks' CEO Brian Niccol saying the coffee chain's turnaround is, quote, ahead of schedule, despite the company reporting its sixth straight quarter of declining same-store sales. Joining us right now with more on the quarter is Brian Harbour. He's U.S. restaurants analyst at Morgan Stanley. Good morning to you. We're looking at the stock now, about $98. Is this ahead of schedule in your mind?
Well, look, I think there's no denying that the numbers are still tough here, but what suggests that it's ahead of schedule? You have a CEO who's very good at testing things. He's accelerating the rollout of this new operating model. I think that suggests that what they've seen in the test stores is very positive. So they're pushing very aggressively with that. We do expect it to drive the next year, drive substantial improvement in the next year.
One of the things that they do plan to do is effectively shutter the mobile-only operations that they had created around the country. What do you think that's going to do for the business, and how much do you think that was taking away from the store, the stores that we know, and whatever that experience is?
That's a very small cohort of stores, but what they're telling you is that the in-store experience at Starbucks is still very important. Brian Niccol certainly has the view that that's what differentiated Starbucks, and they got away from it. So he's saying that's sort of inconsistent with what makes them unique, and so that's not going to be the model going forward. You're going to focus on that in-store experience alongside of course, mobile order and drive-thru are very important for them, right?
What do you think this stock should be worth 12 months out?
Well, look, we have a price target of $103, right? I would point to our bull case, which is up in the 130s, and I think that if things really work out over the next year on the top line, I think this is a business that certainly has a history of very good profit flow-through. I would point to that as perhaps the more optimistic case if things get going. Also, the company is being very heavily incentivized to reduce costs. I think the cost base has gotten too bloated in the past, and so if they deliver on that over the next year or two, I think that does represent quite a bit of upside to earnings.
How should we think about the emergence of Luckin and its emergence here in the U.S.?
Well, what's interesting about Luckin, you only have a couple of stores open so far in New York, right? What's interesting about it is that is primarily a mobile pickup-based concept, right? It's distinct from Starbucks, which is telling you sort of coming into stores, that employee connection is still important. Luckin doesn't necessarily have that, right? So I think our view would be that that isn't a broader threat to Starbucks. Do they establish somewhat of a foothold in major cities? But I don't view that as a broader threat the way it has been in China, for example. I think that's certainly been the case, right?
Which then brings us to the China piece. Long term, what do you think the answer is? What's the unlock for Starbucks in China?
Most restaurants do run a franchise or a license model in China with local ownership, sort of people who know the local market very well. I think the brand is still very well respected in China, but the company is suggesting that they bring in a new majority partner. I think that is the most likely outcome. And I think you'll have someone that very much believes in the future of the brand, as do we. But that model, I think, is just preferred. That's what Yum Brands does. That's what McDonald's does. That's what all of the others do.